Welcome back to Squawk Box. Rick Santelli here live at CME HQ with important breaking news. Personal income and spending and all the Fed's favorite inflation gauges. On the income side, this is all November. We're expecting a number up around 0.4. Comes in a little light, up 0.3, up 0.3. That follows at least up to this point, an unrevised up 0.6. If you recall, prior to 0.6, we had September up exactly the same amount, up 0.3, and the prior month was up 0.2, to give you some context. Now, if we look at spending, expected to be up 0.5%, comes in a little light, up 0.4%. If we look at real spending adjusted for inflation, exactly as expected, up 0.3%, and that, of course, would comp to September, where we're up 0.5%. So we're coming back a bit. And if we look at month over month, personal consumption expenditure pricing index comes in cooler, up 0.1, following up 0.2. Up 0.1 would equal where we were in August. To find a lower number, you have to go to May of this year. Now, if we take a wider view, personal consumption expenditure year over year, expecting a number of 2.5, also comes in a little light, 2.4. 2.4, though, keep in mind, is still hotter than the rearview mirror. And this is important. Came in lighter than expectations, but 2.4 follows 2.3. To find a higher number than 2.4, you're actually going all the way back to July, 2.5. Now, if we look at the core PCE, which is probably one of the most important numbers on a month-over-month basis, up 0.1. That's 0.2 lighter than our last look, and it's cooler than expected. So that's a good thing. Up 0.1. We have to go all the way back to May of this year to find a smaller number. And finally, what I consider the most important number of all, personal consumption expenditure price index year over year, up 2.8, equals where we were, 0.1 cooler than expectations, 2.8. If you go back in time to find a smaller number, that would be easy. That would be September because we round here. So last month was 2.79, rounded to 2.8. Prior was 2.65. To find a bigger number, you're going all the way back to April. So not bad. And if we look at the market's response, it's as expected, because the numbers, for the most part, were a little cooler than expected, even though they really haven't made a huge amount of progress, especially on the year-over-year numbers. So we're currently trading 424, and that's in a 2-year. 424 would be down 8 basis points on the day and virtually unchanged on the week. If you look at a 10-year, currently trading at 450, that would be down 450, an extra 3. That's down 7 on the day, but it's up 10 on the week, which once again really underscores how longer maturity yields have been much stickier to the upside. And if we look at the yield curve today, and this is really important, 2s to 10s hovering a little bit above 26 basis points is the widest, the most steep that yield curve's been in 2.5 years, going back to mid-2022.